Hi, this is Dylan Jovine with Behind the Markets. Happy Tuesday. My team here has been pushing me to do daily kind of little videos so that our readers and our members and folks can get to know us better. And, they're always saying, well, your company's named Behind the Markets. Why don't you take them behind the markets every day? Show them what you're looking at. You've been doing this for 30 years. So I figured, I said, let's try it for 30 days and let's see if people like it. So, this is our attempt to do that, to actually, take you aside, take you behind the markets and show you kind of what somebody who's been doing this for 30 years is looking at. And today's Tuesday at 9 o'clock, the thing that on my agenda today that I'm looking at is the 9 o'clock, we get the S&P Shiller Home Price Index. And, this basically tells you how expensive, it's like a Dow Jones Industrial Average for home prices. Now, this is important because, at the end of the day, home prices have doubled in the past 10 years since 2014. The problem is average incomes have only gone up 13.8%. So the average home 10 years ago cost $200,000. Now it's over $400,000. It's really mind-boggling. It's crazy. But the average income has gone from about $64,000 to $72,000. 13.8%. I haven't looked at the figures today. Now, this is still the hangover effect of two things. The first thing is, low interest rates. We have kept interest rates so artificially low that it has distorted and pushed up asset prices like houses. And remember, interest rates and stock prices, or all asset prices and home prices, they're like a seesaw relationship. The lower the interest rate, the higher the house or stock price goes. The higher the interest rate, the lower the house price goes or stock price, So it's like a seesaw relationship. So we've kept interest rates really low. That has pushed up the housing market so much, and the Fed has been trying to raise interest rates, and the housing market has stopped rising, but it's still kind of going sideways, kind of going down. So the housing market hasn't self-corrected yet, which is really important because, look, over time, housing prices can do whatever they want, but over time, they have to approximate incomes. Think about it. No matter what, basically people spend 30% of their income on a mortgage. So if a price is doubled, if the price of a house is doubled, 30% of your income ain't going to buy a mortgage. So basically over time, those prices will have to come back down to a level that matches 30% of the average income in America. That's the bottom line. This is the nature of it. Sometimes those reversions to the mean or those corrections are very painful. The other thing that's driven up housing prices to really laughable levels has been all the COVID money. This is the other major issue. We have added literally $15 trillion in debt since 2020. And, a lot of that was spent, getting people to stay at home. And we have this work from home culture. So, housing prices are crazy high. If you've been looking for a house, or if you know somebody looking for a house, you know that firsthand. You don't need me to tell you that. So today, I expect to see the S&P Shiller Home Price Index basically come in, at or around where it's been. No shock to the upside or downside, just, kind of still too high. But that is what I am looking at today. And I hope you have a wonderful day. Have a great morning. And remember, we got to play the ball where it is, not where we want it to be. Have a good day.